All right. Hey, everyone. Good afternoon and welcome in. Thank you so much for spending some of your time with us on this beautiful, warm Tuesday. My name is Jess Sims. I'm our event planner here at Compass Mortgage. I'll be facilitating the webinar today as well as sharing all of your questions with John and Caleb. And of course, I'm joined by John and Caleb of the Kambs Jennings group at Compass Mortgage. They know that your clients may have questions about how mortgages work, especially when your clients are preparing to buy a home or perhaps already in the process. And so they really want to be able to empower you to learn the simple way to explain this to your client. So today we're going to discuss how this mortgage market works, why we have one, and then we'll answer all of your questions. So there is a chat box that I want to remind all of you of. We will take all of your questions at the very end, but feel free as we go through this presentation to drop any questions, comments, concerns in there. And then we'll get to those at the very end. And then I already introduced myself as well as the team. So we're going to kick this thing off. John and Caleb, you want to go ahead and take it from here?
Sure. So, thank you, Jessica. So my name is Caleb Jennings with the Kambs Jennings Group. I want to welcome you as well. And what we're going to do, John's going to walk through a presentation today on what is the mortgage market? How does it work? We often get questions from our clients, so we wanted to empower you with the knowledge too, because we think that knowledge is power. And the more you know, the more confidence your client's going to have working with you as well. I know that right now we're in a really hot market where low inventory and there's multiple offers going on left and right. And I just want to share with you really quick how we're winning on multiple offer scenarios is that we have an amazing program. It's called our Get Committed program. It's better than a pre-approval. It's where we do a full underwrite because we underwrite in-house and we can then guarantee the funding of a loan on a to-be-determined property for our client or your client. What that does is when you make an offer, it's not a pre-approval. It's Compass Mortgage saying, we're guaranteeing we can fund the loan, and if the client, we could close as quickly as 15 days. So I just want to put that out there. Feel free to hit us up about that. But without further ado, I want to introduce my partner, John Kambs, who's going to walk through this program for you as we go right now.
Hey, everybody, I'm John. Nice to meet you. Thank you for tuning in. So I've been doing mortgages for longer than I like to admit, but about 18 years now. And I learned when I first got into the mortgage industry, it was, there's a secondary market. And that's what basically the mortgage market is. And I didn't really learn what this was and how it actually worked until probably, I want to say 8 years into my career. And it's really helped me flourish when I can explain this to a client. They're like, oh, wow, John knows his stuff. And we want to pass that on to you. And it's basically why we have a mortgage market, how the mortgage market works, and how to show off this knowledge. And you really can show off this knowledge when you can explain it correctly. It always amazes me now that I know this, that there's so many loan officers, myself included for a time, and so many realtors who just don't know this. So without further ado, we'll go ahead and move on here. But so understanding the mortgage market. So what is the mortgage market? If you can go ahead and go to the next slide, Jess. Why do we have a mortgage market? Okay. And the main reason we actually have a mortgage market is for risk. Okay. There's two types of risks. People tend to think of risk when they think of a mortgage as repayment risk or default risk. And that is a risk. And if somebody lends you a home or you take out a mortgage, there's a certain percentage of people are going to default. A certain percentage of people are going to be foreclosed on. And that's pretty much already baked into a mortgage, or they already statistically account for that when they do a mortgage. But the real risk or the market risk that where the real money can be lost is what they call interest rate or market risk. Okay, so we're going to go ahead and go to the next slide here and explain how that works, and we'll explain it to you simply here. So why we have a mortgage market. Okay, like we said, it's basically risk. And yeah, there's default risk, but the real reason we have a mortgage market is because of interest rate risk. Okay, and to make this a simple explanation or simple example, we're going to go ahead and take a perfect customer loan. So let's say we have somebody who has an 800 credit score, they're putting 10% down, and they're getting a loan of $100,000. Okay, and let's just say that the interest rate is 4%. So if the interest rate's 4%, and just to keep this simple to explain it, we're going to assume a simple interest calculation here. So again, this is a perfect loan. So it's $1 million purchase. They're putting down $900,000. They're taking out a loan amount of $100,000. The interest rate is 4%, simple interest, which amounts to $4,000 in annual interest. We can go ahead and go to the next slide here. So since there is an interest rate risk, and to use round numbers and to kind of talk extremes here, what happens to the value of this loan if mortgage rates go to 8% next year? Is it still worth $100,000? Well, the answer is no, and it's now worth 50%. So here we go. We have this perfect customer loan. Client put down $900,000. The interest rate's 4%. They're making their payments on time. They're even making them early. What could go wrong? Well, if you look here, this $100,000 mortgage is generating $4,000 of annual interest, where a year later, that same perfect customer loan of $100,000 is generating 8% of interest. So that's $8,000 of annual interest. So in an 8% environment, how much would need to be invested to get the same $4,000 return? Well, $50,000. And again, it's calculated on simple interest. So what you'll see here is that this $100,000 loan, even though they're making all the payments on time, even though they put a big down payment down, it has lost 50% of its value. Now, a company can sustain a $50,000 loss. It's ugly, but a company can sustain that. But if we go to the next slide, we'll see that what we'll see is from the risk to a company, and risk at a company scale is much greater when you have $2 billion in loan value, and then interest rates go up 8% to double the amount. Then we have a $1 billion in a loan loss, in loan value loss. And one thing that I'd like to iterate here is that the company doesn't necessarily have to even sell the loan. But if, let's just say that this company wants to borrow against the $100,000 asset that it loaned out to you, well, they're going to value it at 50%. Or let's just say that they're going to do an audit on the company and say, hey, what's the company worth? What are the assets? Well, that $100,000 loan that you loaned somebody, that note, is now worth 50%. So when you get to a greater company scale, there's basically too much risk for a lot of companies prior to a mortgage market. So let's go ahead and go to the next slide and say, enter in the mortgage market, AKA secondary market, AKA securitization. Okay, so what happens now is that the borrower, if you look at this wheel here, the borrower comes to John and Caleb, the Kambs Jennings group of Compass Mortgage. Okay, they come to us and we say, we take the loan application, we write them a pre-approval, we do the get committed program, we close the loan, Compass Mortgage underwrites it, they fund it. Compass Mortgage is going to turn around and sell the loan to an investor. Okay, the investor / servicer is going to be a Chase, a Wells, a PNC. Oftentimes people think that they're the ones who hold the note, but it's actually, when in actuality, the investor knows, just like Compass Mortgage knows, that the interest rate is too great. So they sell it to Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac is what they call an aggregator, and they basically will get billions and billions of dollars from all these servicers throughout the country, and they'll buy these loans, they'll package them up, and then where do they go? Wall Street. Wall Street says, hey, no problem, this is what we do, we're Wall Street. So Wall Street underwrites these $1 billion of loans in big pools. They charge a nice conduit fee to make their money. And what do? They package them into our 401ks, our mutual funds, our retirement plans. If you go through any of your 401k, mutual funds, retirement, you'll see Fannie Mae, Freddie Mac bonds. And ironically, what does Wall Street do is they turn around and they sell them right back to the borrower. So you could say that the same people lending the money are also the same people borrowing the money. And with this securitization, what it does is it mitigates the risk of interest rate risk to the whole general public. There is no one person that takes the $50,000 hit. And this is how the mortgage market works and why we have a mortgage market. So if you go to countries that don't have a mortgage market like this, that's when you'll see all you can get is an adjustable rate mortgage. Why? Because they want to hedge their interest rate risk. They say, hey, if I have to hold this loan for 30 years at 4%, I need to basically have an adjustment come so that I can recoup my losses in the event that rates go up. So the other thing I would note is that if you go to it turns into what I would call a hot potato. So borrower comes to us, we fund the loan. Hey, we got this hot potato. We're going to sell it to the servicer. The servicer says we can't accept this risk. We're going to sell it to Fannie. Fannie says we can't accept this risk. We'll sell it to Wall Street. Wall Street says okay, we're going to sell it to the borrowers. But what Fannie does and Fannie and Freddie do is they're intelligent enough to know that they can't hold these mortgages for long because interest rate risk. So that's why you see 30-day, 60-day, 90-day locks, because they've got to push this over to the Wall Street conduit. So now another thing I would say is that if you look at this wheel here and you remove Fannie and Freddie, what you'll see is, for all intents and purposes, this is how a jumbo loan would work. Okay, so a jumbo loan would still go through the same wheel. It's just that Fannie and Freddie are no longer involved. So instead of having billions of dollars or 3,000 loans to sell to Wall Street, now all of a sudden there's only 100. Okay, Wall Street still charges the same fee to underwrite and securitize the loan. So if the same fee is sold to 100, if the same fee is charged to 100 people versus the same fee being charged to 2,000 people, the fees are going to be higher. So that's why you see there are exceptions to the rule, but usually a jumbo loan is going to come with higher costs and fees, etc. So the other thing I'd like to point out as well is that if you notice the underwriting wheel actually works counterclockwise. So most people think it works clockwise, where they say, oh, the borrower goes to the originator has these guidelines, and then the mortgage company has these guidelines, the investor has these guidelines, where in actuality, it goes counterclockwise, where Wall Street makes guarantees and promises to the borrower based on what their return would be. I mean, that's where you could say the mortgage meltdown happened. You had derivatives going to the borrowers, and borrowers and investors didn't really know what they're buying. But anyway, Wall Street says to the borrower, hey, these are the fees, these are the type of bonds you're going to get, this is the minimum criteria. So then Wall Street goes to Fannie and Freddie, and says, hey, Fannie and Freddie, this is what we want you to underwrite for us to package these. Fannie and Freddie go to the investor and say, hey, investor, these are our guidelines, you need to adhere to them for us to buy them. The investor / servicer. Another good example for the investor servicer is, I heard a metaphor I liked. They don't technically own the loan. They'll manage your escrow account. They'll send you a nasty note if you default, but they're metaphorically like the superintendent of an apartment building. They don't actually own the apartment building. They don't own the units. They just service them for Fannie and Freddie. But this investor is basically going to have guidelines that adhere to Fannie and Freddie, and they're going to go to the mortgage company, Compass Mortgage, and say, hey, in order for us to buy anything to sell to Fannie and Freddie, it needs to have these certain guidelines. So the underwriting wheel actually goes counterclockwise. But what's great about this is when you can explain this to clients, you can tell clients, hey, this is why there is no I would say common sense underwriting when it comes to Fannie Mae and Freddie Mac. You're round peg, round hole. And if you're not, well, then you're not going to be able to go to Fannie Mae and Freddie Mac, and then you're going to typically pay more or have a much harder time getting a loan because the risk is greater, because they're assuming the interest rate risk. So, but when you can explain this to clients and the light goes on, of course, what do the clients say? They say, well, what am I missing out on without doing, if John knows this, like what else does he know that I'm going to miss out on? Or if this realtor knows how to explain this, what else am I missing out on? So that's pretty much it. We'll go ahead and open the floor for questions. I hope you guys found some value in this.
Yeah, so if you have any questions, feel free to put them in the chat and we'll answer those if they come in.
I was just going to say, as I pulled those and reviewed those, I don't know, Caleb, if you wanted to add anything else. If not, that's okay.
No, that's good.
Okay, so we do have Andrea on the line. She said, I want to know what types of loans there are. You had mentioned jumbo, but what else?
So just in general, the big aggregators are going to be Fannie Mae and Freddie Mac and Ginnie Mae and VA. Those are going to be the ones that get securitized to Wall Street and they're aggregators. So those are going to be typically the ones that have the best rates, the easiest way to qualify. But again, if you're not around peg and around hole, too bad. They don't care that you have something that, you know, like, oh, I've got 2 million in the bank. They don't care. It's either you're not around peg and around hole. Then outside of that would be jumbo loans. There are non-QM loans, which again aren't owned by Fannie, Freddie, Ginnie Mae, and are going to come with higher costs, higher fees, higher risk. Anything that, and then typically construction loans, if it's not something like a FHA 203K loan or like a home path Fannie Mae product that is limited, then that's going to be another type of loan that wouldn't have go to an aggregator. But yeah, those are pretty much the type of loans that we offer and that the mortgage market really, the residential mortgage market offers.
And I don't know, she's providing a little bit more information here. I'm not sure if you wanted to add anything else to that, but she has investor clients that need different products other than owner occupant. So I don't know if there's any other.
So yeah, we have those, but they are in the investor market. I don't know if this person is aware, has Fannie Mae and Freddie Mac basically came out, I want to say about a month ago now, and they said that we don't like investment properties, and without belaboring it, they basically said we're not making enough on them, we're going to charge more, and then we're also going to assume that a second home is the same as an investment property now. So if it is a true investor, like a hard money loan or something that's not a Fannie Mae product, we do have lenders for those that we typically refer out to, and we can help with like the Fannie Mae, Freddie Mac investor loans, but there's more risk and higher. You know, Wall Street basically underwrites those with a more risk involved, so the rates are higher, the fees are higher, and we do offer them, and we don't do hard money loans. That's going to have to be something that you're going to have to go elsewhere for, but we do offer some non-QM products and non-owner occupied and products that they can just be hard to qualify for, and but we can help you. Just hit us up.
Okay, cool. Yeah, and I'm going to shoot out your guys' email as well to the chat box, so that way, Andrea, if you wanted to reach out and chat more or have further questions, you all can connect on the side too. What are QM products?
Non-QM? Okay, so so a non-QM loan is back when legislation came out about, I want to say in 2012, which was a quality mortgage, I believe, qualifying mortgage. So non-QM is basically Fannie Mae and Freddie Mac said that we only do QM loans, meaning they're the QM loan. The way I've understood it is that the borrowers actually have no right to go after the servicer from a legal stand, or the end lender, in the event that they have a hardship or something. they can't sue Fannie and Freddie. If I buy a home and 3 years later I lose my job and now all of a sudden I can't qualify, I have no recourse. I can't go and try to sue Fannie Mae and Freddie Mac. Well, non-QM basically was legislation that they put out and said, if you're going to be one of these lenders that does outside of the box type things, then you're going to expose yourself to potential litigation. If you gave John Kambs a loan, a stated loan, some type of loan that was potentially contributed to the meltdown in '08, then you're gonna expose yourself to litigation. So these are lenders that will expose themselves to that litigation. I'm sure you're gonna probably lose every time. I mean, trying to fight these lenders, but they're basically the fancy term for subprime. Like back when subprime was around in 2000 before the meltdown, the lender could basically say, oh, I'm going to give you a stated loan, something you probably should have never had in the first place. And if you go into foreclosure, too bad for you, buyer beware. Well, after that, the non-QM came out and they said, no, buyers can sue now, but it's a non-QM lender that would have to do it. And I think I heard once, this is conjecture, I think, but I think I heard that like the same people who wrote this legislation for non-QM are the same people that went out and created a bunch of non-QM lenders. So it's definitely a choppy,
Yeah.
but it's basically the new way to say subprime is to say non-QM.
And just also, it's just what does not meet the guidelines of Fannie Mae and Freddie Mac, essentially, right? Outside of those guidelines.
No, and I mean, there is like jumbo would still be QM. So it just depends. Like it would be more like bank statement loans. I don't know the ins and outs, but what they consider non-QM, but there are specific things that like negative amortization, I believe, is now non-QM. If you're going to do a negative amortization loan where the borrower can make a payment and still owe more, that's an automatic non-QM loan. Interest only, meaning you're going to pay back, but simple interest like we showed you, like your balance never goes down. If I understand that correctly, that's a non-QM loan. So they're just harder to get, more expensive, and but for people that aren't around pegging around hole, that do have like common sense things like, oh, I have a lot of income, I have my credit's not that good, but I've got $5 million in the bank, I can put $900,000 down on a $100,000 loan. Those people can get a loan. It would just be a non-QM loan potentially.
Thank you all for talking a little bit about that. Can you explain with COVID why the mortgage rate, or excuse me, the mortgage market tightened?
Yeah. So the reason that the mortgage market really tightened was because you have the servicers in that wheel that we showed you. They're still on the hook to make payments to Fannie Mae and Freddie Mac. They bake in default, but they basically, Fannie Mae and Freddie Mac has an agreement with them that if there's default, the servicer still has to make the payments during the default. So it's an incentive for these servicers to go after money to collect money for people who are in default. Otherwise, they could just say, "Oh, what do I care? I don't, I give them my statement every month. I give them their payoff, and oops, they're not paying the mortgage. Oh well." Technically, these servicers are on the hook for the payments, and then once there's an insurance claim made and blah blah blah, they can recoup some of their losses. However, what happened during COVID is they basically said, "Hey, we're going to allow everybody to go into forbearance. All you got to do is call up your servicer, tell them it's COVID-19 related, and you can not pay your mortgage for 3 months, 6 months, up to a year." And the way I understood it is that the unintended consequence of this was that they didn't really elaborate on who's going to pay. And what servicers said were, they're like, okay, like if there's a wave of 20% of the people all of a sudden, and thankfully this didn't happen, but the servicers were really concerned that there was going to be a litany of people who, I think they said they were expecting 3 to 5% of people to actually take into account forbearance. But these servicers were like, well, what if it's 20%? Are we still on the hook for making these mortgage payments? So the government and the CARES Act never really elaborated. And when that happens, basically Wall Street and that wheel that we see tightened to basically say, hey, we may have to prepare for a ton of losses here. And it's the very similar thing that happened in the mortgage meltdown, where you had people who it was like a house of cards, right? Like they're lending money and property values are going up, but all of a sudden the default risks are a lot higher than they expected. All of a sudden they start tightening. All of a sudden they realize that all these properties have been inflated. So thankfully, COVID-19 was not nearly as bad as what they were preparing for. But that's in a nutshell why there was such a tightening with standards and down payments, et cetera.
It's all about risk. I mean, at the end of the day, they're hedging their bets on risk, and that's why you saw the first things to go were jumbo loans, because as you saw on that wheel, Fannie Mae and Freddie Mac don't aggregate the jumbos. Well, like it's just anything you saw that already has more risk got restricted quickly.
Yeah, and thankfully it's starting to come back. Like we're starting to do non-QM again, and the FHA, we're going down to 600 pretty easily again, where there was a moment where it was like 640 is the only way to get an FHA loan. So as the vaccines rolled out, it has gotten better, and we anticipate it to get better and better. And
so we got like a minute left here, really, before we gotta end this session.
Wrap things up.
Yeah.
So one last question here: how can this all impact interest rates? If you want to touch on that a little bit.
Well, this really can't impact interest rates. What does impact interest rates is true supply and demand. So Fannie Mae and Freddie Mac sell mortgage bonds, and that's how they, to Wall Street, and that's basically how Wall Street funds the Fannie Mae and Freddie Mac funds the loans from investors from Wall Street. So I guess the way it could in fact impact interest rates is that if the stock market does really well, then the notion is that money comes out of the bond market and into the stock market. And the stock market has been doing really well, but what Fannie Mae and Freddie Mac have been, or the Federal Reserve has been doing, has been propping up the mortgage market and buying bonds for Fannie Mae and Freddie Mac. Are buying them and putting them on their books to keep interest rates low because of COVID-19. But without the Fed, the better the market does, the actual like stock market and in general, the better the overall economy does, the higher the interest rates, because people go into stocks and more risky investments. Now, the worse the economy does, the more people go into the safe haven, the 10-year treasury or the bond market. So if you look throughout history, typically economic turmoil, low interest rates, low interest rates, low inflation, great times, high inflation, high interest rates. So I know it doesn't necessarily answer your question, but that's the best way.
It's a whole other webinar.
Yeah, how they indirectly impacted, I guess. So thanks for kind of elaborating on that. And then I know we're kind of at time here, so you guys can kind of jump in, wrap things up. Andrea, I know you're pushing out a couple more questions here, but I definitely encourage you to snag John and Caleb's email as well as phone number from this last slide here. They'd be happy to talk more in depth with you a little bit more on this, as well as you have more questions, because I know we're at time. I want to make sure we respect everyone's time as well today. So
yeah, I want to thank everybody, everyone for joining us. And if you do have any questions, just hit us up. We're here to help you, and we'll be talking to you soon.
Thanks, guys. Have a good day.
Thank you. Bye-bye.